Have you ever really thought about what stops your power company from just jacking up your bill whenever they feel like it, especially after something like a big storm? Well, the answer, believe it or not, is buried in a fascinating little accounting rule called IFRS 14. And it actually has a huge impact on the price you pay for things like electricity and water.
So let's kick things off with a simple question. Imagine a massive hurricane tears through your region, causing billions of dollars in damage to the power grid. Why can't your local utility just turn around and double everyone's electricity bill the next month to pay for it all? I mean, they have this massive new cost to cover, right? So what's stopping them?
Well, the short answer is that these kinds of essential industries, they don't actually get to set their own prices. They have to play by a very specific and pretty powerful set of rules. And that concept is called rate regulation. Basically, it's a system where some other group, a rate regulator, usually a government agency or a public utility commission, has the final say on the prices a company is allowed to charge. Their job is to find that tricky balance between letting the company make enough money to stay in business and, keeping prices fair and stable for the rest of us.
Okay, so this whole system of regulated prices sounds pretty good for us consumers. But for accountants, it creates a massive headache. And it all comes down to a huge timing mismatch between when the company spends money and when it's allowed to get that money back.
To make this really clear, let's just invent a company. We'll call them Power Up Inc. They're your friendly neighborhood utility that keeps the lights on.
And then, bam, that hurricane we were just talking about hits. All of a sudden, Power Up Inc. is looking at a bill for $1 billion in storm damage just to get the grid back up and running. That's a huge immediate expense.
And this is where things get really weird because you have two completely different realities happening at the same time. In the normal world of accounting, PowerUp just took a $1 billion loss this year. That would absolutely crush their financial reports. But in the regulatory world, the government board steps in and says, hey, don't worry, you can get that $1 billion back by adding a tiny bit to everyone's bill over the next 20 years. You see the problem, right? The cost hits today, but the money to pay for it is spread out over 2 decades.
So how in the world do accountants deal with that gap? Well, they came up with a really clever solution. You can think of it as a special IOU account that was designed for this exact problem.
And here's the official name, the Regulatory Deferral Account. Now, normally in accounting, you can't just take a giant expense and say, poof, it's an asset now. That is a huge no-no. But this is a special case. Because a regulator has guaranteed that the company will get paid back by its customers, the expense gets special treatment. The easiest way to think of it is as a formal regulator-approved IOU from the customers to the company.
So here's how it works, step by step. First, the storm hits, and PowerUp has that $1 billion cost. Second, the regulator officially approves the plan to get that money back over time. Third, and this is the magic trick, instead of booking a huge loss, PowerUp creates a new $1 billion asset, that IOU account. And finally, over the next 20 years, as that money is slowly collected through bills, that asset gets paid down to zero, perfectly matching the cost with the recovery.
So that system works great locally. But we live in a global economy with global accounting rules. And this is where IFRS 14 comes into the picture, acting as a really crucial bridge.
Which brings us to the next big question. What happens when our company, PowerUp Inc., has to switch from its local accounting rules over to the International Financial Reporting Standards, or IFRS, which are used in over 140 countries around the world?
And yeah, here's the problem. The main IFRS rulebook is very, very strict, and it generally does not allow a company to turn an expense into an asset just because some regulator promised they could get the money back someday. That special IOU account we've been talking about, it just doesn't fit into the global rulebook.
And that is where IFRS 14 comes in to save the day. You can think of it like a special temporary hall pass. It basically says that a company switching over to IFRS for the first time can keep using its old accounting methods, but only for these specific regulatory accounts. It's a bridge that lets these unique local rules coexist within the global framework, at least for a little while.
But look, IFRS 14 isn't a total free pass. It comes with some really important conditions, and they're all centered around one key idea: transparency.
So the biggest change is actually how this stuff gets presented. Before, that $1 billion IOU could be kind of buried inside a generic line item called Other Assets. But the new rule is crystal clear. You have to break it out and show it on its very own line. No more hiding. Everybody gets to see it.
The rule also demands a lot more explanation. Companies have to describe who regulates their prices, and, this is the big one, they have to talk about the risks. What could stop them from getting that IOU money back? What if a new regulator changes the rules? Or what if customers start using way less electricity because of solar panels? Investors need to see those uncertainties spelled out.
In fact, the standard itself says the whole goal is to help people understand the amount, timing, and uncertainty of the future cash that's supposed to come from these accounts. It's all about providing clarity.
Okay, let's zoom out for our final section here and take a look at how all this fits into the bigger picture of global finance.
So here's something that's really important to remember. IFRS 14 is just a temporary fix. It was specifically designed to be an interim standard, kind of a holding pattern. The board that makes these international rules, they know this is a super complex area, and they're still working on a big, permanent solution. So this bridge we've been talking about, it's not going to be around forever.
Which really leaves us with this final, massive question. IFRS 14 is a perfect example of just how challenging it is to set global standards. I mean, think about it. How do you possibly write one single set of accounting rules that works for a tech startup in California, a giant bank in London, and a regulated power company in a place that gets hit by storms? It is a massive puzzle that the rulemakers are still trying to solve.